All right, well, my next guest says that April's jobs report was exactly what the Fed wanted to see. Sort of like hitting 3 cherries on a slot machine, folks. Ching, ching, ching. We had less strong jobs growth, weaker wages, and higher U3 unemployment. Let's bring in Wells Fargo CIO for Wealth and Investment Management, Darrell Cronk. Darrell, welcome to the show.
Thanks, Charles.
All right, so this is everything, at least maybe the Fed wanted to see it, certainly the markets wanted to see it, but really maybe even more pressure after that FOMC meeting where Powell had his back, his back against the wall a little bit there.
Yeah, I think what Powell did last week was he took rate hikes off the board, right? Which the markets loved.
Right.
So now all we've got is you either stand pat, higher for longer, or we cut rates, right? But you took some of that asymmetrical risk of them raising rates off the board. The bar is really high for them to do that now.
But which is interesting to me because he's supposed to be data dependent.
Yes.
So, to do that, but just also if you put 3 rate cuts out there, which they did, and some maybe wonder if he, ironically enough, might have done himself more harm than good because by putting those rate cuts out there, the stock market goes up, the wealth effect, maybe a connection to inflation.
Yep.
So he maybe didn't do himself any favor with those 3 rate cuts in the dot plot.
I think that's right. But remember, the Fed's been wrong all the way along. If you spin the clock back to the beginning of 2023, when we were still hiking rates, there was 3 rate cuts priced into the Fed funds futures for the back half of 23. That didn't happen. We walk into this year with 6 rate cuts in. That didn't happen. As we stand here today, there's 1 rate cut, and they've pushed it out to November now, right? All the way out to November.
2 days after the election.
Correct.
All right.
And what's 1 rate cut going to do? It's symbolic,
Sure.
right? It's not going to change the dynamics of what, the grind of interest rates is.
This rally, the 3 days coming in, the best 3 days since November. Even today, we're showing a little bit of moxie, but it still feels like it's missing something. It doesn't feel like we're off to the races right now.
Yeah, obviously April, first down month in 5, right? It's interesting if you look at the technicals. The 20-day on the S&P 500 pierced through the 50-day from above, right? Which is never usually a good sign.
Right.
It puts some downward pressure. Now, the last couple of days, we've recapped and recouped the 50-day. We're not sure it's going to hold. We think this is a little bit of a kind of a double top forming that rolls back over, ends up below the 50-day, and then a lot of blue sky down below the 50-day to the 200.
You start talking 5,000, 4,800.
That's right.
Your year-end targets, maybe that's why your year-end target is only 5,200. Next year, though, you're looking at 260 on earnings, 5,700. So you're even looking for a little bit more valuation expansion, PE expansion as well.
A little bit, but mostly PE multiples stay the same. 260 is still about $13 below where the street's at for next year.
Right.
So we do think there's limited growth there. But just like we come in every year, they're going to have to mark earnings growth down, right? This double-digit 11, 12% earnings growth that are in the bottoms-up, top-down consensus isn't going to happen. It's going to be more like the 6, 7% we're seeing in Q1.
Yeah, I kind of alluded to that at the beginning of the show. I like it when they start to ratchet them down.
Yes.
Equity preference, large over small, developed over emerging, which is intriguing because small is so undervalued compared to large historically, and I think emerging markets to our markets are like maybe the lowest they've ever been over 50 years. So, but you're saying stick with what's working, right?
Yes.
But by the same token, I'm kind of rushing because we only have a minute to go, and I want to get all of your brilliance. Also, energy, healthcare, materials, and industrial. So this is intriguing because the things that have driven our markets not here. You are saying it is time to rotate, though.
Cyclicals.
Cyclicals.
Right? Pro-cyclicals will still serve you well here. What people don't realize since the last election, Charles, the best performing sector by far and away, not technology. It's energy.
Right.
It's killed it since the last election.
What about some of these others? It feels like these are layups, right? Considering all the money that's coming into this economy.
The CHIPS Act, the IRA.
Right.
You can't go into an airport without, massive construction happening anywhere across. So that's all benefiting industrials and materials. Materials is a little bit of a proxy play on China, right? China's rallied hard the last few days, so it's giving a boost to materials. But materials are pretty cheap right here.
Before I let you go, then, what's your concern? What's the most pressing concern?
So I think people aren't paying attention to the yield curve right now. It's changed materially in the last several months. The short side of the yield curve, the 3-month to 2-year, is now inverted by 60 basis points. That's a huge cliff inversion. The long side is almost tabletop flat and maybe with a little bit of a slight slope. Why does that matter? It matters because the short side has more signal than noise in it. It tells you what's going to happen in the next, coming months, which suggests that the ride's going to get a little bumpy here as we go through the summer months.
And a slowdown?
Yeah, a slowdown.
But not necessarily recession.
No recession yet, unless something breaks.
Okay, great stuff.
Thanks,
Great
Charles.
seeing you.
You too.